Hi guys, this is Anastasia Green. Welcome to the New Leaders Show. And today we have another amazing guest, Jinal from Runa Capital. By the way, congratulations to Runa Capital. Just last week, Jinal was speaking at our conference, and today they announced that they raised another fund, $157 million oversubscribed. Good job. Today, Jinal will be speaking about how to spot potential acquirer and what to do when you actually have a deal on the table. I'm sure Jinal doesn't need your subscribe button, but our channel does. So click subscribe button and see you in the end of the video.
Thanks so much. So my name is Jinal, and it's amazing that previous speakers did an awesome job of already setting up the stage. So I feel like my job is going to be significantly easier. I'm going to talk about how to spot potential acquirer and what to do when the proposal comes in. In terms of my experience, I'm a founder myself. Founded two companies, one of which is venture-backed, and the other one is bootstrapped. Both of them are still around. And the company that I went through the M&A process is the venture-backed company. It's called SchoolMint. It's an online student enrollment and retention platform for pre-K to 12 schools. It was acquired in 2017, has more than 125 employees, and serves 16,000 plus schools in the US. I've also founded a completely bootstrapped company that provides remote engineering teams for a lot of customers in the US, like AngelList, NFX, Hire, and others. And I'm also a venture partner now at Runa Capital, and what we focus on is early stage money for seed as well as Series A, sometimes Series B, in vertical SaaS, which includes fintech, educational technology, digital health, as well as deep tech. And then we have funded some of the top companies in these domains. We manage more than $400 million. So let's talk about how to spot a potential acquirer. As you start building a company and as you start growing the business, people will notice you, right? I mean, they will see that the company is doing well, the customers are happy, the business is growing, and they could be of different forms. They could be a much bigger firm, strategic, that operates in the same domain as you are, or they could be a very well-funded startup that's either trying to get into the domain that you are serving, type of customers you're serving, or it at least already has a product that's similar to you. And that could be competitors, either of the same size, of a much bigger size, or they could be competitors in a different vertical and they want to enter your specific vertical or specific type of customers that you're serving. It could also be private equity roll-ups, and something that Sergey already outlined, where there are a lot of private equity firms that want to deploy money in good capital efficient companies with ideally good margins, ideally good EBITDA. And so they are looking for either platforms, or they are looking also for add-ons to these platforms that makes a lot of sense for those platforms. So again, it could be strategic, could be strategic who is also a competitor or just competitors from a vertical market, same vertical that you are in, or from a horizontal market and they want to enter your vertical, or it could be a private equity owned platform. They might see you as a platform, or they might see you as an add-on. So given that it's very important as you're building the company, and I highly recommend that don't start with an aim of just getting acquired. I mean, it's a good aim to have, but your focus should still be on building a good business with solid product market fit, good growth, ideally amazing margins, and even better in this world, today's world, it's either profitable or has a really clear sight to profitability. Having said that, it's good to know who these potential acquirers could be, because that's when the time is right, and when you're exploring, you don't want to start from scratch. And so it's important to know whether they are a strategic that aligns with what you are doing, or it's a competitor that you're keeping an eye on, or it's just a private equity roll-up that's happening that could be interesting to you. It could be even better if you start building up relationships with them without obviously giving out or sounding too desperate to get acquired. And those relationships could be in form of just a quick check-in or a high-level check-in with them every quarter, every few months. Or it could be a deeper, where you have some sort of partnership with them. And that partnership could be about co-selling opportunities to similar type of customers. It could be about co-marketing opportunities, where you are filling a gap that they had, or vice versa. But it's important to build up that relationship, because that not only helps you see if there are synergies, it also helps you get to know them better. It's a fine line you want to tread, because you don't want to sound too desperate. On the other side, you also don't want to completely write them off. It's good to know who they are, build up relationship. It's also good to provide them with high-level updates about your business, continue to keep them excited, what you're doing. Again, without sounding super desperate. So let's assume you build a great business, you have identified potential acquirers, and you continue to grow the business. And at some point, a proposal comes in. In most cases, and I don't know how founders visualize, but in most cases, it's not like you just get a complete out of the without your thoughts. Someone sends you an email with an offer. That never happens. Yes, you will get pinged by corp dev teams, private equity teams, depending on who the potential buyer is, and they will constantly ping you about get to know your business a little bit better, but it's never completely in the dark. Ideally, a lot of discussions will happen before an actual proposal comes in. So what do you do when it comes in? And the first thing first is you really have to convince yourself if this is the path that you want to go down, for a lot of reasons, right? It can be a huge distraction for the business, especially if you're not thinking of selling the company, or your board is not thinking of selling the company. It can be a huge distraction for you. It can be a huge distraction for the company, unless you're smart about not engaging everyone. Ideally, you want to keep it as stealth as possible from your team's perspective, so that the company can keep executing while you're getting engaged. But make sure that this is what you want to do, and make sure that your board or your co-founders, your board, everyone is aligned that that's the right direction. Partially because it's easily a 2 to 3 month commitment, even more, and it can be draining, especially if things don't go well. It can have a long-lasting negative effect on you as well as your team, and also potentially your business. So make sure that there is a strong alignment. And then once you decide together with the board, okay, this is the right thing you want to do, this is the right thing for the business, then review the offer, because that's probably the first kind of thing you want to see is this the offer that you want to even entertain? Does it have the right pricing that your investors are looking for? Does it have the right type of things that are outlined in the LOI? Because that's one of the first thing you negotiate. And if you don't do a good job of negotiating that, then basically at that point, you're already giving up a big chunk of your leverage that you have. So before signing the LOI, make sure you're okay with the enterprise valuation, you're okay with things like working capital calculation, non-compete, exclusivity period, because most sophisticated buyers will ask for an exclusivity period. And so that's the time when you cannot go and shop around. So they will have clauses around no shopping. And so make sure that those are the things that are right. Ideally, I would highly, highly recommend that make sure you at least have additional offers, because that will build up your leverage. I would highly recommend ideally working with a banker or someone from your board who can act as your banker. And that does a few things. First is it allows you to open up possibilities that you might not know of. It allows you to understand and make sure that you are getting the best offer in terms of the valuation, in terms of other things that matter to you. That could be legal stuff around non-compete, that could be structure around if they're asking you to roll over, if there are any earnouts and things like that. So for all these purposes, the best thing to do is have more and more options available to you, so that then you can pick and choose from those options. Even if you decide to go eventually with the first buyer that made an offer because of the strategic fit, you still want to keep that door open for additional offers before committing to one or two of them. And so the best way to do that is run a good process, either using a banker or using someone else who can act as your investment banker. It also helps you negotiate the deal better, because you are not the person directly negotiating, and the banker is doing it on your behalf. And that helps you continue to have a good relationship, because as someone mentioned before, some of these buyers could end up becoming your future boss. And so you want to keep that leverage of getting the best deal without burning any bridges.
If you still have any questions to Jinal or to me, please drop the comment below. We love your questions, we love your comments, likes and shares. It means the world to us. And see you in the next episode.